Hey everyone, and welcome to today's Explainer. So, today we're diving into what is literally the absolute bedrock of surviving the crypto markets, and that is financial risk management. Our source material for day 16 outlines the exact mechanics of protecting your capital. So, let's get focused and jump right in.
The source material for our curriculum puts it super bluntly, calling this exact module one of the most important days. And honestly, they are not exaggerating. This is the ultimate crucible of your trading education. You can have the absolute best entry signals in the world, but without what we're about to cover, one bad swing in these highly volatile crypto markets will completely wipe out weeks of hard work.
Okay, here is a quick look at the agenda for today. We'll start with the day 16 turning point, then move into micro defense, follow that up with macro defense, and wrap everything up with the risk calculator.
All right, part 1. Welcome to day 16, the turning point.
Moving right along to part 2, micro defense individual trades.
Okay, let's get granular here. The very first piece of your micro defense is defining your risk per trade. This right here is the fundamental baseline of your survival. Before you even think about clicking a button on an exchange, you need to know exactly how much of your capital is deliberately exposed on this one specific market move. Like, if you have a $10,000 account, are you risking $100, $50? Setting this parameter creates a hard, mathematical line in the sand. It ensures that absolutely no single trade can ever take you out of the game completely.
Now, working perfectly in tandem with that risk limit is your position sizing. Once you know you're only willing to risk, say, $100, your position size determines the actual volume of the crypto asset you can purchase to safely within that limit. It dictates exactly how many tokens or coins you buy based on where your safety net is placed. This makes sure your risk exposure stays perfectly fixed no matter how erratic the asset's price becomes.
So how do we actually enforce this safety net in real time? Well, that's where your stop loss comes in. A stop loss is your ultimate automated failsafe. Think of it like an ejection seat for your capital. You program the specific price level into your exchange, and if a trade turns against you and hits that mark, you are automatically pulled out of the market. It strictly captures downside and instantly removes all that human hesitation, fear, and hope from the equation.
All right, so you know exactly what you're prepared to lose, right? But now we have to contrast that capital put at risk against the potential upside. This is your risk versus reward ratio. If you're risking that $100, what's a realistic target for profit? Are we talking 300, 400? Calculating this specific ratio is absolutely not negotiable before taking action. If the potential reward doesn't mathematically justify the risk you're taking, you simply do not take the trade. It really is that black and white.
Okay, on to part 3, macro defense, portfolio guardrails.
So, zooming out from the micro level of just a single trade, we really need to look at the health of your entire portfolio. These time-based risk boundaries, going from a maximum daily loss over to a maximum weekly loss, are incredibly powerful guardrails. The rule is super simple. If you hit your maximum daily loss limit, you walk away from the screens for 24 hours. If you hit the weekly limit, you're done for the week. This system prevents a bad day of revenge trading from destroying your week, because let's be real, we've all been tempted to rage-click a buy button. And it stops a bad week from wiping out your entire account. It acts as a strict operational circuit breaker for your trading business. Now, when we visualize drawdown, which is just the decline from your account's historical peak down to its current low, we uncover this pretty brutal mathematical truth. It's a truth that newer traders almost always misunderstand. Look at it this way. If your account draws down by 50%, you don't just need a 50% gain to get back to even. No, you actually need a whopping 100% gain just to recover to where you started. Truly understanding the absolute gravity of drawdown is what forces a trader to respect those daily and weekly limits we just talked about.
Which brings us to part 4, the risk management calculator.
So, this brings us to the final practical mandate of our explainer today. The source material gives us one very clear directive: create a risk management calculator. And here is exactly how a trader fulfills that requirement using everything we've covered so far. Step 1, you input your desired position size alongside your strict risk per trade percentage. Step 2, you establish the exact price for your stop loss and calculate the risk to reward ratio. And step 3, you hard-code your daily, weekly, and maximum drawdown limits right into the system. Whether you build this in a simple spreadsheet or use a dedicated trading app, plugging in these predefined metrics completely automates your defense before you ever enter a ticker symbol.
As we wrap up this explainer, I really want to leave you with a question that goes way beyond just the math. You've got the blueprints now, right? You completely understand the tools and the metrics required to survive. But Do you have the discipline to actually follow your own calculator? When the market is moving incredibly fast and the adrenaline is pumping, it is so tempting to trade on emotion and just ignore the very safety nets you built. The structure is there to save you, for sure, but only if you have the fortitude to let it. Think deeply about that the next time you sit down to trade. Thanks so much for joining me on this explainer, and keep learning.